with Roth, you can't borrow against it. You can't actually get like an S block. So that's these next two bullets sort of count. They're both sort of together. But you can't borrow against a Roth. It's just because it's a qualified account and it doesn't have a legal structure. Like a 401k loan is a legal structure around being able to access a 401k or 401k funds, but you don't have that in a Roth IRA. That's a limitation. Now, with my whole life policy, I can borrow against it directly at 5.7%, and insurance-backed line of credit. Right now, it's like prime -1, maybe as good as that. So, really, the rates are not going to be great right now in the I block. So the preferred method would probably be to, if I'm gonna access funds in my whole life, I'll probably take a direct policy loan for now until the interest rate environment improves. There's two parts to this video, so if you want to see the other video in this series, then check out this link up here or the video description or top comment. With my IUL policy, I have a few different loan structures, well, two specifically. I can take a 5% index loan, and that's the real power of this IUL. By taking that index loan, I can continue to allow my funds to grow, and that's really where it connects to this next bullet as well. So when we look at these two lines in conjunction, it really plays together. The other option I have is a fixed loan of 2.91%, and both the 5% is fixed for the life of the policy, and 2.91% it does come down. So at year 11, I can take a 1.96% interest rate loan. And then with those lower interest ones, they credit my policy with 2%. Currently, it'd be like a net payment of a 0.91% rate to the insurance company, and then like later it'd be like basically a wash. But if I'd rather pay 5% when I know it's quite likely that I'm going to earn 8 to 10% in a given year, or even more. And we'll walk through in this video how I can earn more than that. And so, I've talked through some of these things. So when we talk about earning in two places, with either whole life or IUL, I can take loans against the policy or an I block, and then I can use that to purchase real estate. So I'm continuing to earn compound interest on those funds that I have a loan against. Yes, I'm paying interest to the insurance company when I'm doing that, but I do have the opportunity for arbitrage. If the interest rate environment is good in it with the whole life, with an I block, I could be paying less in interest to the bank that I have the insurance-backed line of credit with than I am earning in my whole life policy. Now the bigger one is in the IUL, and this is the main reason why if I was going to select one of these vehicles, it's because of this index loan feature and my understanding of how I will likely earn on the average more than this rate that I'm paying here. So it's called arbitrage. This go between the interest rate I'm paying the insurance company and what I'm earning on those funds. That's the arbitrage. So if the insurance policy is earning 10% and I'm paying 5% with that index loan, then I'm earning 5% on funds that I'm also purchasing real estate with. And that's why this is extremely powerful. That's why an IUL can become an income stream that just lasts forever, because you continue to earn based on that accumulation value, not just the cash value. You continue to earn on the full amount. So that's the main reason why, if I was going to select one, to have perpetual access to all of my funds and all of my gains at any point that I needed it. That's why I can fund an IUL so high, access it at any point, and use it to grow wealth elsewhere as well. So how do gains happen inside of all of these things? Well, in a Roth, it's pretty straightforward. This is you're getting your gains based on the ETFs, mutual funds, stocks, options, whatever you're doing inside of that Roth account. That's how you're getting your gains. I pretty much do all of those. I do ETFs, mutual funds, and stocks and options inside of my Roth. It's where I do some riskier stuff, shooting for those bigger gains inside of that Roth. For me personally, I don't plan to rely on my Roth. One thing is you can pass your Roth to your beneficiaries, so that's another benefit of the Roth over traditional IRA or 401k, the RMDs, like number of factors, but that's how a Roth works basically. So with whole life companies put the majority of your funds into very secure assets that pay smaller returns. So for example, high-rated bonds, private equity, government-backed mortgages. They're in very, very secure investments that will pay out consistently over the long term. And as a policyholder in a mutual company, you're part owner, and you'll receive a share of the profits as dividends. So that's how my policy earns money. IUL companies, they do the same type of investments as a whole life, and many whole life companies might offer an IUL as well. But if you have an IUL with a mutual company, you're not actually an owner of the company in the same way that you are if you have a whole life policy with them. So, but an IUL will do those same types of investments, like what is considered the general account, and they'll do those same kinds of secure investments as the whole life company. But with an IUL, you choose, rather than to take that 4 to 6% return in those secure investments, you tell the insurance company, hey, buy call options on this given index. And so just with those yields, so if you have 100,000 in the index, they're going to take 4 to 6,000 of that yield, where they have the secure investments where they're earning that 4 to 6, maybe a little bit more. Like they're probably earning like 7 if they're paying you 5 or 6. So they're going to buy $5,000 worth of options. They're not going to buy the index itself. And so if the index goes down, those options expire worthless. If the index goes up, then you get the gains. And that's how they give you a 0% floor or a 1% floor. And we'll get into why I like the 1% floor, because it's a good strategy. And then what am I currently doing? So for 2021, I think I contributed I think around $14,000 between my Roth 401k and my Roth IRA, through a back door. And I'll probably be doing similar to that for 2022 and continuing on. I'll continue to fund these things for sure. I currently put about $60,000 per year into whole life, and I currently put about $70,000 per year into an IUL. That's $70,000 after a few years. I think I have to bring that down to like $56,000 and some change. But so it should average around to about the same as I'm putting into the whole life. And I might end up putting more and opening more policies, but I'm not going to discuss that in this video. So I have another video where I break down my personal index universal life policy that I'm putting $70,000 a year into. But this is just going to cover some of those same topics, and there's been some updates even from when I put out that video. So there's a concept of participation rate, bonus, and then asset charge. This is that 1% asset charge where that's what I was talking about with the potential to have 1% loss. I like this strategy still because it has this 40% bonus. And basically what they do is they take this 1%, you say, hey, take an extra 1% from my cash, my accumulation value, and allocate that to purchase some more options on the index. That's basically what they're doing when you use this strategy. And so similarly, they're here. So in this one, this is the Bloomberg U.S. Dynamic Balance ER2 index. Here's the ticker symbol. You can't really find data on this on the open internet. You can find it, but it's not going to have charts and stuff like normal index funds or things like that. So, but this is the historical performance. So this column right here, that's the historical performance of this index. And when we look at this, you can see that this is consistently doing pretty well, but it's not like mind-blowing performance. The thing that is kind of like mind-blowing performance would be like this 2017 35% return or this 2019 30% return. But they're doing that with a 14% and 12.83% return respectively. So I have a spreadsheet breaking down these different strategies to compare actual returns that I made as well. And so here's this example with $200,000 of cash value at this 12%. So this is basically simulating the return of 2019. So when comparing these, we have a what is the return? This is the same amount, 30.43 showing here on the the 2019 return, and that's the same thing here. So this is where we can compare these things and say which one wins in this, and for actual values, and that's what this is showing here. So we can see that this strategy wins out based on all of the inputs that are defined at the top of this chart here. So that's why I personally split. I'm most heavy in this 40% bonus and 1% asset charge, and then I split with this 15% bonus. Those are the two strategies that I employ in my policy. So where does the changeover happen that this is actually, it's less advantageous to be in this 40%? The 15% bonus and the standard no bonus, they're not really any different. I don't know why they even have both of these. It's just mathematically they're basically the same. But so we can see though that this is ahead at that 2.41. So if we switch this to 2.42, you can see that this is still ahead at 2.42. Let's do 2.43. If you're tired of the same old advice of just buy index funds and forget about anything other than pinching all of your pennies to make sure you achieve financial independence, then subscribe to keep up with our content. I'm all about building out income streams, unconventional wealth growth strategies, That's the kind of content that I put out. I also do index investing, but that's only one part of my overall strategies. So it's still ahead. Let's do 2.5. So 2.5 for the Bloomberg. So one thing is there's an extra kicker on the 15% bonus. It gives you this extra participation rate. And basically that participation rate is just multiplied by what the return is. So if the index does, 10%, if the index does 10%, that actually becomes 18% with this. So that's why these numbers get really kind of crazy. So 2.5 with this slightly higher participation rate, this is still ahead. So it's actually looking like if we change 2.5 to 2.51, that's really close. So the return rate here is really close now. So let's say 2.61, 2.65. Now they're basically equal, but this is slightly ahead when actually calculated out. I don't have enough precision on this return rate. So 2.65 basically makes them equal. So that's where it starts to pull ahead. And we're talking very, very small numbers at this point. But basically, like around a 2.65% return on the index results in this the 15% bonus being better. So when we look at this, though, historically, there's not very many of those scenarios. So we can see here. So this would have been a year that was better. This would have been a year. 2007 would have been better for the 40%. So 2008 would have been the 15% would be better. 2015 the 15% would be better. 2018 the 15% would be better. But yeah, so like, and then all the rest of the years, this 40% bonus would be best, and that's why I choose that one for my heaviest allocation. So that's the gist of it. That's basically the entire reason behind, if I was going to choose one vehicle, it would be an IUL. It's having that downside protection and what is likely going to be very similar returns to my Roth. I might do, in reality, because I can take so much risk in my Roth will likely end up outperforming my IUL in the long term. But the reason I can take that much risk in my Roth is because I know I have whole life and IUL getting me those much safer returns and protecting me on that downside.